Every trader begins with the same hope to find consistency, certainty, and a sense of control over a market that feels unpredictable. Yet the market itself is never the real challenge. It simply reflects movement, opportunity, and probability. The real challenge is internal. The journey toward profitable trading doesn't unfold in sudden leaps, but in clear psychological stages that shape how you interact with risk, uncertainty, and your own expectations. These stages quietly separate those who struggle endlessly from those who eventually master the craft. The first stage is fueled by excitement, curiosity, and the illusion of control. You believe the charts will reward your intelligence, your analysis, or your effort. You assume the market behaves like a logical system that responds to your predictions. In this stage, you chase outcomes rather than processes. You search for the one strategy, the one indicator, or the one piece of information that will eliminate uncertainty and make winning feel effortless. But the more you look for certainty, the more the market reminds you that it doesn't owe you consistency. Losses in this stage feel personal because you interpret them as failures rather than a natural part of the probability model you haven't learned to trust yet. Eventually, the emotional weight of inconsistent results pushes you into the second stage, the stage of conflict. Here you know what you should do, but you can't consistently do it. You've learned enough to see that discipline matters, that risk must be controlled, and that probability, not prediction, is the foundation of trading, but old habits remain. You hesitate when you should act, and act impulsively when you should wait. You battle fear after losses and overconfidence after wins. You start recognizing that the market isn't your opponent, it's your mirror. It reflects your beliefs, your impulses, and your internal contradictions. This stage is uncomfortable, but it's necessary. You're being confronted by the psychological gaps that separate knowledge from execution. The third stage emerges only when you finally let go of the need to control the market and commit to controlling yourself. At this point, trading shifts from emotional chaos to structured clarity. You accept the randomness of individual outcomes, understanding that each trade is just one event in a long series. Your focus moves from being right to behaving correctly. You respond to the market's information instead of reacting to your fears. You trust your system because you trust your ability to follow it. Profitable trading becomes a natural byproduct of consistent behavior rather than emotional battles. In this stage, confidence is quiet, discipline is automatic, and results accumulate because your psychology no longer interferes with your strategy. These three stages outline a path every successful trader eventually recognizes. It's not about finding secrets in the charts. It's about evolving into someone who no longer needs certainty to perform with consistency. The market doesn't change, you do. Accepting uncertainty as the foundation of consistent trading requires a fundamental shift in how you interpret the market, yourself, and the meaning of risk. Most traders enter this business believing that certainty is something they can eventually acquire through study, indicators, patterns, or experience. They assume that the more they learn, the more the market will reveal stable, predictable behavior that rewards knowledge with precision. But this expectation quietly becomes the trap that keeps them frustrated, inconsistent, and emotionally reactive. The reality is that the market offers information, not guarantees. Every moment in the market is a unique combination of variables that has never existed before, even if it resembles a pattern you've seen. The market does not repeat. In a perfectly mechanical way, it only echoes familiar structures. And because every pattern has infinite variations, the outcome of any individual event remains uncertain no matter how much analysis you apply. Accepting this is not simply an intellectual understanding. It demands psychological acceptance, which is an entirely different level of internal alignment. When you seek certainty in a probabilistic environment, you create internal tension. You expect the market to behave in a way that matches your analysis. You expect a trade to work because you've identified a setup that looks clean, logical, and historically successful. When the trade fails, the gap between expectation and reality creates emotional friction. Fear, frustration, confusion, or disbelief appear because you believe the market violated something it never promised. This emotional friction is the source of hesitation, premature exits, revenge trades, and the endless cycle of trying new strategies in search of one that removes uncertainty. But no strategy, no matter how advanced, can remove randomness from the outcome of any given trade. A strategy simply defines the probability of outcomes across a series of trades, not the certainty of the next one. Until you accept this at the deepest psychological level, your emotions will continue to fight the nature of the market. Acceptance of uncertainty means releasing the need to know what will happen next, and instead building confidence in what you will do next. The shift is subtle but transformative. It moves your internal focus from outcomes to actions, from prediction to preparation, from emotional attachment to objective execution. When you no longer seek certainty from the market, you remove the emotional burden that makes trading feel volatile internally. You stop interpreting losses as evidence that something is wrong with your system, your skill, your analysis. You begin to see them simply as part of the distribution of results that every strategy produces. Just as a casino expects losses in individual hands while maintaining profitability over thousands of outcomes, a trader who accepts uncertainty thinks in terms of series, not single trades. This acceptance creates the psychological space needed to follow rules consistently. When you are no longer emotionally threatened by the possibility of a losing trade, your decisions become cleaner. You take valid setups without hesitation because you are not trying to avoid discomfort. You let winners run because you're not afraid of giving back unrealized profit. You cut losses quickly because a losing trade carries no emotional meaning. Your identity is no longer tied to the result of a single trade, and so your mind no longer distorts information to protect your ego. This frees you to see the market as it is, rather than as you want it to be. That clarity is what allows consistent traders to act decisively even in environments that feel ambiguous or uncomfortable to others. A trader who has not accepted uncertainty constantly searches for more confirmation. They want to eliminate the possibility of being wrong before taking a position. They add indicators, wait for extra signals, or adjust setups because they believe more information will create more certainty. Instead, it creates more hesitation. The trade feels safe only when it looks undeniably obvious. But by that time, the edge is gone. They enter too late, play stops too tight, or panic when the trade retraces in a normal way. Their entire experience is dominated by fear of loss because loss represents the collapse of the illusion that the trade was certain. When that illusion breaks repeatedly, confidence deteriorates and emotional volatility increases. This cycle continues until the trader either quits or finally understands that certainty must be abandoned, not pursued. Accepting uncertainty does not mean trading recklessly or ignoring analysis. It means grounding your approach in probabilities instead of predictions. You define your edge, quantify your risk, and plan your actions ahead of time. Then you execute without expecting the market to reward you immediately. You're no longer trying to force the market to validate your analysis. You're simply allowing your edge to play out across many trades. This mindset frees you from emotional swings and brings your behavior into alignment with consistent performance. Confidence is no longer a fragile state that rises with wins and collapses with losses. Instead, confidence comes from knowing that your system is designed to perform over time and that you have the psychological ability to follow it. The acceptance of uncertainty also changes how you interpret price movement. Instead of seeing randomness as something threatening, you see it as the natural environment in which your edge operates. You stop trying to avoid losses and instead integrate them into your expectations. You stop trying to catch perfect entries and instead focus on executing repeatable setups. You stop trying to predict turning points and instead trade with the flow of your system. The market's unpredictability becomes something you work with instead of something you resist. This cooperation with the nature of the market produces a calm internal state that is essential for consistency. A trader who truly accepts uncertainty begins to feel a sense of internal neutrality. Wins don't produce euphoria, and losses don't produce despair. You remain emotionally balanced because you understand that each trade is just one event, nothing more. Your emotional energy is no longer consumed by fighting the randomness of outcomes, and that creates a level of mental clarity that few traders ever experience. This clarity allows you to see trade opportunities as probabilistic edges rather than emotional bets. It allows you to execute without hesitation, manage risk without fear, and grow your account without the psychological turbulence that undermines most traders. Accepting uncertainty is ultimately about aligning your beliefs with the true nature of the market. When your beliefs match reality, there is no internal conflict. Without conflict, there is no emotional interference. Without emotional interference, consistency becomes possible because your actions become stable, disciplined, and rooted in probability rather than hope or fear. Focusing on process over prediction is the shift that separates a trader driven by emotional impulses from a trader grounded in consistent performance. Most people approach the market with the belief that success comes from knowing where price will go next. They try to anticipate the next big move, the next breakout, the next reversal, or the next candle pattern that hints at a guaranteed direction. This predictive mindset feels natural because humans are conditioned to avoid uncertainty. Prediction seems like the path to safety, clarity, and confidence. But in the markets, prediction becomes the root cause of emotional turmoil. It creates pressure, attachment, and a constant inner battle between what you want to happen and what the market is actually doing. The truth is that the market does not reward prediction, it rewards consistent execution of a repeatable process that aligns with a probabilistic edge. When you focus on prediction, every trade becomes a test of your intellect. You seek validation. You want to prove that your analysis was correct, that your reading of the market was superior. This mindset subtly transforms the trade from a probabilistic event into a personal statement of worth. When the market moves against you, it feels like an attack on your competence. When the market moves in your favor, you feel temporarily powerful. These emotional fluctuations make consistent behavior impossible. You hesitate when fear enters, chase when greed spikes, and abandon your rules when your predictions fail. The deeper problem is that prediction is an illusion. No trader can consistently forecast the exact outcome of a single trade. The market contains too many variables, too many participants, and too many unknowns to ever behave in a perfectly predictable way. As long as you rely on prediction, your emotional state becomes unstable, your decisions become inconsistent, and your performance becomes unpredictable. A process-focused trader operates with a different mindset. The goal is not to be right about what happens next, but to follow a clearly defined method that produces desirable results over a series of trades. They understand that each trade is just one iteration of their system. The outcome of an individual trade does not matter nearly as much as whether they executed their process correctly. This shift liberates them from emotional attachment. A losing trade is not a failure. It's simply part of the statistical distribution that their system operates within. A winning trade is not a confirmation of brilliance. It's the mathematical outcome of following their rules. This neutrality creates a stable psychological environment where discipline is not forced but naturally maintained because the trader's sense of confidence is rooted in something reliable, the process itself. The process encompasses everything that can be controlled: identifying setups, managing risk, defining entries and exits, position sizing, journaling, reviewing trades, and maintaining emotional awareness. These components become the framework that guides decisions in real time. By grounding themselves in this structure, the trader avoids being swayed by fear, frustration, or excitement. Their actions become mechanical, not because they lack creativity, but because they understand that consistency only emerges from repeatable behaviors. A trader who relies on prediction is constantly improvising. A trader who relies on process is executing a practiced routine. This difference is what creates long-term survival and profitability. When you focus on prediction, you often overlook risk management. You assume the trade will work because your analysis feels strong. This creates oversized positions, wide stops or no stop at all. You expose yourself to catastrophic losses because prediction convinces you that risk is unnecessary. In contrast, a process-oriented trader treats risk as a central pillar. They understand that any trade can fail, so they structure their risk accordingly. They size positions logically, place stops strategically, and protect their capital without hesitation. Their primary goal is not to avoid losses, but to prevent any single loss from damaging their overall probability model. This mindset preserves emotional stability and maintains long-term consistency. A trader who focuses on prediction also tends to chase perfection. They want the perfect entry, the perfect exit, the perfect analysis. This obsession leads to paralysis. They wait for extra confirmation, hoping to eliminate the chance of being wrong. By the time they act, the edge is diluted or gone entirely. The market begins to feel hostile, unpredictable, and frustrating, not because it changed, but because their approach is incompatible with its nature. The process-focused trader understands that perfection doesn't exist in the market. They aim for high-quality setups, not flawless ones. They enter when their rules signal an edge, not when the trade looks emotionally comfortable. This ability to act in the presence of uncertainty is what builds a consistent equity curve. Another key difference lies in how each mindset handles randomness. Predictive traders interpret randomness as a threat. They feel blindsided when a strong setup fails. They feel betrayed when price reverses sharply after entering. Their emotional state swings with the market because they expect logic to overcome probability. But randomness is a permanent feature of the market. A process-focused trader embraces it. They expect randomness, they expect streaks of wins and losses, they expect outlier candles, unexpected reversals, and periods of chop. Because these events are expected, they do not cause emotional destabilization. The trader remains calm, centered, and consistent, applying the same method regardless of the outcome. Focusing on process over prediction also redefines success. For predictive traders, success is measured trade by trade. Each win feels like progress, and each loss feels like regression. Their confidence is fragile because it depends on recent results. If they experience a losing streak, they question everything. They doubt their ability, adjust their system impulsively, or abandon their strategy altogether. The process-based trader measures success differently. Success is not the outcome of a single trade, but the accuracy of their execution. If they followed their rules, managed risk correctly, and executed with discipline, then the trade, win or lose, was successful. This internal definition of success creates a deep, unshakable form of confidence that does not fluctuate with market randomness. Over time, this mindset builds momentum. With every executed trade, the trader reinforces their belief in the process. With every journal entry, they refine their approach. With every review session, they strengthen their discipline. The mind becomes trained to operate within structure rather than emotion. The market becomes less intimidating because it no longer determines the trader's emotional state. The trader becomes resilient, stable, and consistent because they've shifted their identity from being a predictor of outcomes to being a manager of probability. By focusing on process over prediction, the trader transforms their entire relationship with the market. The market's behavior is no longer something to fear or control. It becomes something to work with. The trader stops fighting the nature of uncertainty and begins operating within it with clarity and purpose. Controlling behavior rather than market outcomes requires a profound psychological shift that most traders never fully make. The instinctive desire to influence or predict what the market will do next is rooted in the human need for certainty, safety, and order. Yet the market is an environment that offers none of these guarantees. It operates independently of your wishes, fears, analysis, or expectations. Trying to control outcomes in such an environment creates a constant internal conflict. The frustration you feel when the market moves against you, the fear that arises when price hesitates, the impatience that surfaces when a setup takes longer than expected, all of these emotions emerge from the unconscious attempt to control something you cannot influence. Once you release this need and shift your attention to controlling your own behavior, trading becomes radically clearer, calmer, and more consistent. Most traders believe they're fighting the market, but they're really fighting themselves. Every impulsive entry, every emotional exit, every revenge trade, and every moment of hesitation is a reflection of internal patterns, not external conditions. The market has no intention, no agenda, and no awareness of your presence. Its movement is simply the collective behavior of millions of participants, each acting on their own information and beliefs. When you try to control outcomes, you set yourself up for disappointment because the market will move the way it moves regardless of what you want. This leads to emotional turbulence, frustration when trades fail, euphoria when trades work, fear when uncertainty appears. These emotions become the invisible drivers of your decisions, pulling you away from your plan and into destructive habits that sabotage long-term consistency. Controlling your behavior means recognizing that your power lies not in shaping the market, but in shaping your responses. Your rules, your risk parameters, your execution, your emotional discipline. These are the areas where you have absolute control. A trader who focuses on controlling behavior builds a framework that protects them from their own biases. They define their edge clearly, set their risk before entering a position, determine their exits in advance, and commit to acting on their plan regardless of the outcome of any individual trade. This alignment creates a stable mental environment where decisions are made based on structure instead of emotion. When you commit to this mindset, your trading becomes consistent because your behavior becomes consistent. When traders fail to control their behavior, they react impulsively to the uncertainty of the market. They close trades too early because they fear losing unrealized profit. They hold losing trades too long because they hope the market will reverse. They skip valid setups because a previous trade resulted in a loss. They increase size massively after a winning streak because they feel invincible. All of these actions share the same core problem. The trader is allowing the outcome of the market to dictate their behavior instead of allowing their behavior to dictate how they participate in the market. This inversion of control is what causes emotional spirals and inconsistent results. When you focus on behavior, you separate your identity from the outcome of any single trade and anchor it in the quality of your execution. Controlling behavior also means controlling your internal dialogue. The market triggers emotional responses because every price movement threatens or enhances your beliefs about your abilities. If a trade moves in your favor, you feel validated. If it moves against you, you feel threatened. This cycle creates emotional noise that distorts perception. To break this pattern, you must neutralize losses and wins in your mind. Each trade must be seen as one event in a long series, not as a reflection of your self-worth. This mental neutrality is essential for consistent execution because it prevents you from exaggerating the significance of individual outcomes. When your self-image is no longer entangled with results, you remain calm, focused, and rational regardless of what the market does. A trader who controls their behavior understands that discipline is not a reaction but a proactive commitment. They don't wait until they feel disciplined. They create discipline through structure. They use checklists, trading plans, routines, and journaling to ensure that their actions align with their rules. They approach trading the same way a pilot approaches flying or a surgeon approaches an operation, with a system that minimizes the influence of emotion. This doesn't eliminate uncertainty, but it gives you a reliable framework for operating within uncertainty without losing control. Another dimension of controlling behavior involves managing risk. Risk is the only variable in trading that can be fully controlled, yet many traders resist it because acknowledging risk means acknowledging uncertainty. They place stops too wide or not at all because they want to avoid the emotional discomfort of being wrong. They size positions impulsively because they're trying to force the market to give them a larger win. Both behaviors reflect an attempt to control outcomes. In contrast, a trader who controls behavior respects risk automatically. They understand that risk management is not an obstacle to profit, but the foundation that protects the long-term viability of their edge. They see each trade as a business decision rather than an emotional wager. Controlling behavior also means recognizing the patterns in your own psychology. Many traders repeat the same mistakes for years because they never examine the internal beliefs driving their decisions. Fear of missing out, fear of loss, need for validation, desire for excitement. These emotional forces influence behavior far more often than traders realize. When you bring awareness to these patterns, you gain the ability to interrupt them. You begin to see that the market does not create your emotions. It merely triggers what already exists within you. The more control you gain over your internal patterns, the more stable and disciplined your trading becomes. As you deepen your ability to control behavior, the market begins to feel less chaotic. Price movement no longer dictates your emotional state. You stop reacting impulsively to every fluctuation. You stop interpreting randomness as personal significance. Your trading decisions become deliberate, measured, and aligned with your predefined edge. You begin to experience a sense of calm even in volatile environments because you are no longer fighting the market or yourself. Instead, you are following a process that reflects clarity, self-awareness, and discipline. Ultimately, the shift to controlling behavior over outcomes transforms not only your trading but your internal experience. Instead of being dominated by hope, fear, and frustration, you operate from a place of clarity and confidence. Instead of trying to shape what the market does next, you focus entirely on shaping what you do next. This is where consistency begins, because consistency is not found in predicting outcomes, but in repeatedly executing behavior aligned with a probabilistic edge. Replacing emotional reactions with rule-based actions is one of the most defining transitions a trader can make, yet it is also one of the most challenging. Emotional reactions arise automatically, often before you even recognize what you're feeling. They come from fear, hope, frustration, greed, impatience, and the unconscious need to avoid pain or seek pleasure. In a market environment filled with uncertainty, these reactions get triggered constantly, sometimes multiple times within the same trade. If you don't have a structured set of rules to override these impulses, your decisions will swing back and forth with the emotional tides generated by the market's movement. A rule-based approach is not about suppressing emotions, but about creating a framework that prevents emotions from becoming the driver of execution. The human mind is not naturally wired for trading. It is wired for survival, and in survival mode, the brain interprets uncertainty as danger. When price moves against you, your instinct is to react, either by closing a trade prematurely to avoid loss or by holding on to avoid admitting defeat. When price moves rapidly in your favor, your instinct may push you to grab profit too early in fear of losing it. These responses are automatic because the brain equates financial risk with emotional risk. Without a system of rules to intervene, these instincts will dominate every decision you make. This is why traders who rely on feelings consistently experience hesitation, premature exits, emotional entries, and destructive behaviors that sabotage long-term consistency. Replacing emotional reactions with rule-based actions begins with recognizing that emotions are not the problem, acting on them impulsively is. You cannot stop fear from arising, but you can prevent it from dictating your behavior. Rules provide this protection. They serve as a pre-commitment mechanism, a way of deciding in advance how you will respond to market conditions before emotion enters the picture. When your rules are clear, entry criteria, stop placement, position size, trade management, exit signals, you no longer need to interpret the market in real time. You simply follow what you predetermined when you were calm, rational, and not influenced by the uncertainty of the moment. A trader who doesn't have rules is constantly improvising, trying to reconcile the noise of price action with the noise inside their head. This creates cognitive overwhelm and emotional exhaustion. Every trade becomes a battle between logic and instinct. You may start a trade with a plan, but the moment the market moves unexpectedly, the plan dissolves and emotions take over. In contrast, a trader with well-developed rules has a clear map. When price moves, they don't interpret the movement emotionally. They check whether it aligns with their predefined structure. If it does, they act. If it doesn't, they don't. This removes the burden of decision-making under stress. Rule-based trading also creates consistency because it eliminates randomness in your own behavior. The market may be unpredictable, but your responses don't have to be. When your actions are consistent, your edge has the opportunity to express itself. Without rules, your edge, if you even have one, gets lost in the chaos of emotional decisions. Rules transform your trading from reactive to methodical. They help you maintain objectivity, allowing you to see the market clearly instead of through the distortions created by fear or greed. One of the most important parts of replacing emotional reactions with rule-based actions is removing ambiguity from your trading plan. Ambiguity invites emotion. If your entry rules leave room for interpretation, emotions will fill that space with excuses. If your stop placement is discretionary, fear will push it farther away. If your exit criteria are unclear, greed will argue for staying longer while fear argues for leaving early. Clarity eliminates debate. When the rules are precise, you no longer negotiate with yourself during a trade. You simply follow what is defined. The process requires honesty. Many traders claim to have rules but do not consistently follow them. The rules exist on paper, but their real trading decisions are still governed by emotion. To truly replace emotional reactions, rules must become non-negotiable. This means following them, even when it feels uncomfortable, inconvenient, or counterintuitive. Following rules during winning streaks is easy. The real test comes when you face a series of losses, when confidence weakens, and the urge to adjust your system appears. If you break rules when you're uncomfortable, you haven't replaced emotional behavior, you've simply hidden it behind the illusion of structure. True rule-based action emerges when you execute your plan regardless of emotional resistance. Rule-based trading also requires preparation. You cannot expect to follow rules in the heat of the moment if you haven't practiced them when the market is closed. Reviewing charts, analyzing past trades, identifying mistakes, and rehearsing your strategy mentally all reinforce your ability to act according to structure. Preparation builds familiarity, and familiarity reduces emotional intensity. When your rules become second nature, following them becomes automatic rather than forced. Another dimension of replacing emotional reactions is environmental control. Traders often underestimate how much their surroundings influence their emotional state. Distractions, noise, fatigue, overtrading, lack of sleep, and even poor physical habits amplify emotional responses. When the mind is tired, rules become harder to follow. When the body is stressed, fear intensifies. A disciplined environment supports disciplined decisions. This includes limiting screen time, avoiding unnecessary exposure to news, setting specific trading hours, and creating structures that reduce emotional triggers. Replacing emotional reactions with rule-based actions also reshapes how you interpret losses. Most traders react emotionally to losing trades because they perceive them as failures. This emotional interpretation increases fear, which then distorts decision-making. A rule-based trader views losses differently. If the trade followed the rules, then it was successful even if it lost money. This mindset is essential. It prevents emotional baggage from carrying over to the next trade. It keeps your mind neutral and prevents overcorrection. When losses lose their emotional weight, they no longer trigger impulsive reactions. The transition to rule-based action is not instantaneous. It requires persistent effort and repeated practice. You may notice yourself wanting to break your rules, and that moment of awareness is progress. Every time you choose structure over emotion, you strengthen the neural pathways that support disciplined behavior. Eventually, rule-based action becomes your default mode. You begin to recognize emotional impulses as noise rather than commands. You feel a sense of stability even in volatile markets because you no longer depend on emotional interpretation to make decisions. With time, you begin to trust your rules more than your feelings. You trust the logic of your method more than the discomfort of uncertainty. You trust the process more than the need for control. This trust becomes the foundation of your consistency. It anchors your decisions, stabilizes your emotions, and aligns your behavior with the long-term expression of your edge. Building confidence through disciplined execution is not about feeling certain, fearless, or emotionally energized. It is about creating a deeply internalized belief that you can trust yourself to act consistently regardless of uncertainty. Most traders think confidence comes from winning trades or having a system that looks perfect on paper. They assume that once they find the right strategy or accumulate enough successful trades, confidence will appear naturally. But this kind of confidence is fragile because it depends entirely on outcomes the trader cannot control. The moment losses occur, their confidence collapses. The moment the market behaves unpredictably, their trust in themselves is shaken. True confidence is not built on outcomes. It is built on the ability to execute your plan with discipline across all market conditions, especially when the outcome is uncertain and the emotional pressure is high. Confidence begins with self-trust. If you cannot trust yourself to follow your rules, manage your risk, and remain committed to your process, then no winning streak can give you real stability. You may feel confident temporarily, but that confidence will disappear as soon as the market challenges you. Disciplined execution transforms self-trust from a concept into a lived experience. Every time you follow your rules, regardless of the trade's outcome, you reinforce the belief that you are capable of consistency. Each disciplined action becomes a building block in the foundation of your internal strength. With enough repetition, this becomes an unshakable belief that does not depend on the randomness of individual results. Most traders underestimate how much discipline contributes to emotional balance. When you execute your plan consistently, your emotional reactions decrease because you know that you behaved correctly. A losing trade does not create fear because you know the loss was part of your system. A winning trade does not create euphoria because you understand that the win is not a personal achievement, but the natural expression of your edge. This emotional neutrality is the core of real confidence. It prevents the highs from making you reckless and the lows from making you hesitant. It keeps your decisions stable, your perception clear, and your behavior aligned with your long-term goal of consistency. Disciplined execution also creates predictability in your internal experience. The market may be unpredictable, but your responses are not. You know how you will react when a trade sets up, when a trade moves against you, when a trade hits your stop, or when the market becomes choppy. This predictability removes fear because fear thrives in uncertainty, not the uncertainty of price movement, but the uncertainty of your own behavior. When you don't trust yourself to act consistently, you feel anxious because you cannot predict what you will do next. Discipline removes this doubt. You begin to experience a sense of internal control, even though the external environment remains random. Building confidence through disciplined execution also means accepting that discipline will often feel uncomfortable. The market will tempt you to break your rules with beautiful setups that appear at the wrong time, by making a losing trade look like it just needs a little more room, or by offering quick profits that make early exits feel justified. Discipline is the ability to resist these temptations not because resisting feels good, but because you are committed to something larger than immediate comfort. You are committed to consistency, longevity, and the expression of your edge over time. With repetition, the discomfort fades, and what once felt restrictive becomes the core of your freedom as a trader. Another dimension of disciplined execution is routine. Discipline becomes exponentially easier when it is built into a structured daily process. Pre-market analysis, journaling, reviewing trades, checking emotional state, setting alerts, defining risk parameters, and following routines that support mental clarity all reinforce consistent behavior. Routine removes randomness from your approach, and the absence of randomness reduces the space where emotions can distort your decisions. Over time, your routine cultivates a sense of stability and confidence because you experience trading as a controlled process rather than an emotional reaction to every tick on the chart. Confidence also grows when you view your trading performance in terms of series rather than individual trades. Disciplined traders understand that each trade is one event in a much larger sample size. They do not evaluate themselves based on single outcomes. They evaluate themselves based on how faithfully they executed their method. This perspective dramatically reduces emotional intensity. Fear and hope lose their influence because each trade becomes a data point, not a referendum on your competence. This mindset creates space for calmness, which strengthens discipline, and discipline strengthens confidence in a reinforcing cycle. A trader who builds confidence through disciplined execution also cultivates resilience. They understand that losing streaks, drawdowns, and unexpected market conditions are inevitable. Instead of reacting with impulsive adjustments, they rely on structure. They review their trades objectively. They identify patterns in their behavior. They reinforce what's working and correct what isn't. This reflective process is essential because it prevents emotional reactions from turning temporary setbacks into long-term damage. Each time you recover from a difficult period through disciplined actions, your confidence becomes deeper and more durable. In contrast, traders who rely on emotional reactions constantly sabotage their own confidence. When they break rules, they may experience temporary relief, but the cost is long-term instability. When they chase trades, hesitate, overtrade, or deviate from their plan, they create doubt within themselves. Doubt accumulates. It erodes trust. It makes every future decision feel heavier, riskier, more uncertain. Emotional traders are not just fighting the market, they are fighting their diminishing belief in themselves. No amount of knowledge or experience can overcome the loss of self-trust that comes from repeated inconsistency. Confidence built through discipline also enhances your ability to remain present. You stop replaying past mistakes. You stop worrying about future outcomes. You operate within the moment because the moment is where your rules apply. When you live mentally in the present, you perceive the market more accurately because your thoughts are not clouded by fear of repeating past losses or greed for future gains. Presence sharpens your focus, improves your execution, and aligns your perception with what the chart is actually showing rather than what your emotions want to see. Over time, disciplined execution becomes your identity as a trader. You no longer see yourself as someone who reacts to the market, but as someone who responds according to structure. This identity shift is incredibly powerful. It changes how you speak to yourself, how you handle setbacks, and how you interpret market information. Discipline becomes a natural expression of who you are rather than something you force yourself to do. And once discipline becomes part of your identity, confidence emerges effortlessly because your actions consistently align with your beliefs, your goals, and your process. This kind of confidence is sustainable. It does not vanish with losses. It does not inflate with wins. It remains steady because it is grounded in something you control completely, the quality of your execution.